All right. So my baseline understanding, we'll start with 179D, then let's get into 45L. The way when I look at it and I try to watch some videos and gain some knowledge before I sit down, I like walking into a room not knowing anything, Dawn, but you're the expert here. I don't know much. A government grant deduction, is that what it is? Or tell me, what is 179D energy incentives? What is it?
I wouldn't use the word grant because that's transferring of cash. The deduction part it is actually very similar to the cost segregation when we're talking depreciation. So the 179D, the calculation is completely different, but the result is also accelerated depreciation. So when you're talking to anybody and they're talking about what they can get, even if you're just looking an individual looking at your 1040, they tend to think credit, and a credit is $1 for $1. You get your kids' tax credit, your child tax credit, these things kind of come and go. That is $1 by dollar reduction of your actual tax. You owe $100 in tax, less $100 credit, zero. A deduction, though, is before tax. So you have to take your deduction amount, multiply it times your tax rate, and then it looks and feels like a credit, because the deduction is kind of like your standard deduction.
So off the top, I can take this off the top
before you get to taxable income, before you've applied your tax rate. So that is a key distinction here. So we're talking about depreciation with cost seg. We're also talking about depreciation acceleration with 179D. But like I said, the incentive and how you get to that number is completely different. But that's what it ends up being. It's a deduction. So then whatever you think your deduction is, multiply it times whatever your tax rate is. So what happens is you can have a completely different tax rate than me. And so the benefit could be completely different in your hands as opposed to my hands. Whereas the credit to each of us is worth $1 for each dollar. So it's a little bit interesting just in how these incentives, how they really give them to us. They're on different platters.
So if I'm understanding correctly, and this is the time where you say, Justin, you're wrong, right? If I'm wrong, and that's okay, please do, because I don't want anybody calling me later. You didn't say something right, Justin. So Dawn's going to correct me if I'm wrong here. So if I'm thinking about cost segregation and being depreciation, that is for offsetting income. For 179D, can I have a scenario? Let's say I build a building, and let's say things are tight, Dawn, and I'm putting everything I got into this building. I've only got savings I'm putting in. I don't have a bunch of income coming in. Am I able to basically take it all off the table from the IRS, and they're going to actually cut me a check at the end there just for being a good citizen and smiling at everybody? Or how does that work?
Nope. So what you're thinking about is a refundable credit. There's very few of those. Only like the earned income credit do you actually can go below zero and then get money back from the government that you never paid in. So that's rare. But in this case, what you can do, you can go all the way to zero, and then you can hold that it's a net operating loss. It'll just throw you beyond that zero and carry forward it to next year, so that when you do have income, you'll use it to offset that. And you can carry forward for 20 years, just like the net income loss rules in general.
So you're saying I can basically put this thing in my wallet like it's a gift card to a store that I've only visit when I go to my in-laws. And when I come back there one day, I can just pull this sucker out and say, haha, got you. Was saving this for a rainy day. And I can do that.
Yeah. And it makes sense, because you as an investor, you aren't going to do anything just to lose money. You are trying to make money. So if you're building a building, initially you're going to be building it. You're going to be paying for it. You aren't going to have any rental income yet from that building. So that might take you, like you said, years to actually get that project going. You're going to be in a net operating loss for a while. And then you're going to start getting those rents in, and then you're going to hold that property longer. And then they are patient. The IRS and the government, they are very patient, and they'll wait until you have that income, and they will let you take those losses. Think about the income tax system that we have now. It cuts off every 12 months. I mean, that's a fictitious date. That's not how business runs, So taking your loss forward until you can use it, it just makes sense.